Hello everyone, and how are you all doing today? So today we're going to be doing yet another ACCA Performance Management past paper question. And this time the question we're going to be doing is from the June 2014 exam. So this is a quite old exam format, so they didn't even apparently have sections back then. So we're going to be doing question 3 of the exam, which is a 20 marker written type question. And obviously we're going to be doing it on the computer in an Excel file since the exam is now computer based. Okay, what I like about this question is it handles some topics which aren't that frequently tested in the past papers released by ACCA for this exam in section C, that is. So one is ratio analysis and financial analysis, such as your ROC, asset turnover, operating profit margin. And the second part of this question has to do with transfer pricing, and it has its own unique twist in the question, and it's very good from a conceptual point of view for us practicing such questions. Okay, so 20 marks, again, from an exam point of view, 1.8 minutes per mark. You would roughly have 36 minutes for a section C question. Generally speaking, you take a bit more time in section C as compared to the multiple choice, so you could put this at 40 to 45 minutes if need be. Okay, so let's get into the question and see how it goes. Okay, so as always, we'll start with the requirement. So it says requirement A, discuss the performance of C Co and each division of W Co. So there's two divisions for W Co, design and gearbox division, calculating and using the following three performance measures. So it's the ROC, the asset turnover, and the operating profit margin. Note, there are 4.5 marks available for calculations and 5.5 marks available for discussion for a total of 10 marks. So this is something I need to highlight first. Whenever they say this, it immediately puts some students on the backtrack. For some reason, students are not comfortable with performing analysis, and they're much more comfortable with the calculation, even though analysis is easier, to be honest, and quite frankly the more interesting part. So what we're going to do in this question is we're going to do the calculations and the analysis, but in the analysis I'm going to go into a lot of detail. Okay, not more detail than is necessary for you to get a very good mark on this answer. Why? Just so that any students who aren't so familiar with how analysis goes can get a taste of it, right? The way you learn how to do good financial analysis is, one, you become aware about how it's performed, and then you practice it more on your own. So right now I'm going to try to address the awareness part, right, of what possibilities you could have when analyzing something, and this question is very good for financial analysis practice. Okay, so we have three ratios we need to calculate, and if you remember, these three ratios are interconnected. So ROC, operating profit over your capital employed. Asset turnover is your, remember, whenever there's a turnover ratio, whatever precedes the word turnover is in the denominator. So assets is in the denominator, and for most turnover ratios, the numerator is sales. So sales over assets. And operating profit margin. A profit margin always has sales in the denominator and the corresponding profit, operating profit in this case, in the numerator. So they're all interconnected. Okay? So just based on that, the fact that we need to do the calculations and then analyze, we'll need to go through the numbers for the calculation and then go through the information above for benefiting us in the analysis part. Okay, so we'll start by labeling our question number 3. Okay, remember to make it bold, italic, underline, something like that to distinguish it from the rest of your answer. And part A, we need to highlight that as well. Let's do all parts 1, 2, and 3 collectively, so it'll just be part A that in our label. Okay, so we have our three ratios and we have three divisions, so we can make a 3 by 3 table. Let's make our columns the ratios and the rows the companies or divisions. So we have ROC, we have the asset turnover, and we have the operating profit margin, right? And let's just stretch these out a bit so that it's easier to follow. Okay, make these bold, and let's put these in the center as well, right? A little bit of time spent on presentation. Don't go overboard with the time spent, because ultimately, if you're running out of time, you should focus on the answer more than presentation. But if you have time, please put in a bit of effort to make it presentable. The marker always appreciates that, and that'll make them more inclined to give you marks. Okay, so we have CCO, we have WCO's two divisions. We have the design division, and we have the gearbox division. Okay, so there we have it. So return on capital employed is operating profit over capital employed. Now the good news is they've already given us capital employed directly over here. Sometimes they don't do that. They'll give you assets, liabilities, etc. In which case, what was the formula for capital employed? Just for recap, it was total assets minus current liabilities. Okay. And generally speaking, ROCE, we take controllable profit over controllable capital employed. In this case, let's just read through the case in case there's any controllability aspect there. So it says Rotech Group comprises of two companies, WCO and CCO. WCO has two divisions: design division, which designs wind turbines and supplies designs to customers under licenses, and gearbox division, which manufactures gearbox for the car industry. CCO manufactures components for the gearbox. It sells the components globally and also supplies WCO with components. So that's where the transfer pricing comes in. CCO supplies WCO. Okay, and the financial results are given. So no mention of any controllability aspects. So we'll simply take the operating profit in that case instead of controllable profit, and we'll take the capital employed. So operating profit over capital employed for ROC. So for CCO, the operating profit is 7,010 divided by 82,975. Okay. For design, it's going to be 6,000 over 23,540, and for gearbox it's going to be 3,875 over 32,320. Now remember, the ROC is a percentage ratio, so let's just make it a percentage. Okay, let's give it a few decimals in any case. Yeah, okay. Now apart from that, we have asset turnover, which was sales over assets, or sales over capital employed is an alternate we can use as well. Usually in the performance management exam, they want you to use sales over capital employed, so we'll do that. So for CCO, sales were, so there's external and sales to gearbox division, which are internal sales, for a combined 15,560. We have to take the combined. Okay, the split of external internal doesn't factor here, over the capital employed 82,975. Okay, then we have the sales for design division, which is 14,300 divided by 23,540. And please do make sure to double check that you're putting in the right numbers for the right division, right? It's very easy to mix that up. And for gearbox division, we have 25,535 divided by 32,320. Okay, so 0.79, right? And for the, again, let's just format this a bit. So it's a decimal number. Remember, asset turnover is not in terms of percentage, rather it is in terms of times, right? And operating profit margin is simply operating profit over sales. So we'll have for CCO 7010 divided by 15,560. Okay, and for design we'll have 6,000 divided by 14,300, and for gearbox we'll have 3,875 divided by 25,535. Okay, and this too is in a percentage. And remember the link between these three ratios we covered, right? So which of these two multiplied together gives us a third? It's the asset turnover times the operating profit margin, which gives us the return on capital employed. Just to demonstrate, if we take the asset turnover for CCO, multiply it by the operating profit margin for CCO, we get, right, we get 8%, 8.4%, right, the ROC. And since we've done this, let's just quickly copy paste it just to demonstrate that our calculations are correct. Okay, now, so that was 4.5 marks, so 0.5 marks per number basically. Okay, but now the discussion part, 5.5 marks. And as I said, we'll go into a lot of detail, more than you probably need to in the actual exam, just so that we can practice the analysis part. Okay, so the way to approach this when you have all these different numbers is start ratio by ratio. So we have the return on capital employed. What is this? Basically, how many dollars in operating profit margin you generate based on the capital employed. So as we can see, CECO by far has the lowest return on capital employed, and the design division has the highest. Okay, so usually when you do analysis, it's better to start with the extremes because they're more easy to explain. Now again, analysis is not, as I've been repeating over and over again, saying, oh, design division has the highest ROCE, so that's good, and CECO has the lowest ROCE, that's bad. That's not analysis, that's stating the obvious. Analysis would be understanding why CECO has the lowest ROCE and why design division has the highest. So if we go back to our information, it says the design division designs wind turbines and supplies the designs to customers under licenses. Okay. Now, what does that mean? They're basically just doing design. They're not manufacturing. Unlike Gearco, which manufactures gearboxes, and CECO, which manufactures components for gearboxes. And when you have a service company that just does design, what do you think? Will it have more assets or less assets than a manufacturing company? It should have less, because they're not making something physically, they're just making a service, so they'll have labor. And if we go down to our capital employed, you can see that's the case. CECO and gearbox division have much higher capital employed than the design division, just because of the nature of operations, right? So you generally expect the design co to have less capital employed, therefore they'll have a higher ROC just by that nature. So that's one point we can write. So design division, so let's give headings so that we can mention which formula, which ratio we're analyzing each time. So design division has the highest ROC. One reason for this could be, you don't need to be definitive, just use light wording, the fact that it is a service company compared to the other two that are manufacturing companies. Due to this, it will have lower capital than the other two, which will increase the ROC, right? So either your ROC is going to be higher if you have lower capital employed or a higher operating profit. So that's one explanation, okay? And if we look at CECO, it has an even lower ROC than Gearbox. And now here we can't use the point that, oh, one's a service company, one's a manufacturer. Both of them are manufacturers. Why does CECO have a much lower ROC than Gearbox division? Okay, so it says Gearbox manufactures gearboxes for the car industry. CECO manufactures components for gearboxes, and it sells components globally. So Gearbox's operations seem to be limited locally, whereas CECO is multinational all across the world. And if you're a multinational compared to a local company, where do you expect to find more capital and assets? Obviously in the multinational, because they'll have factories and premises all across the world, right? So that's the second point we can make. So CECO has the lowest ROC. One reason for this could be the fact that it has operations globally, meaning it has offices and factories in multiple areas, causing their capital to be very high and their ROC to be lower as compared to the divisions of WCO, right? So there's another point of analysis. Now it's 5.5 marks available for discussion, so technically 2 points per ratio would be sufficient, right? So let's continue. If we need to add more points here, we can do that down the line. So asset turnover. Okay, So in asset turnover, we still have capital employed. Oops. We still have capital employed, but now sales are in the numerator. Okay, and if we look at it, something interesting happens. So design still has a pretty high asset turnover compared to Seco, but it has a lower asset turnover than Gearbox Co. And Seco still has by far the lowest asset turnover. So we can still make the point it's because of the high capital employed. But what about Gearbox? Why does it, even though it has a lower ROC than design, it has a higher asset turnover than design, right? Let's explore what a reason for that could be. So, Gearbox manufactures gearboxes in the car industry, and Seco sells components to Gearbox. So that might be the answer there, right? If Seco is selling components to Gearbox, right, it's selling them based on a transfer price. Now Gearbox's operating profit is low, but the sales comparatively, based on the high asset turnover, is high compared to your design division. In other words, Gearbox's sales are okay, their expenses are unusually high, which is why design division's ROC is higher even though their asset turnover is lower. And if you compare the operating profit margins, that's what's happening. Gearbox has a very low operating profit margin compared to design. So basically, their expenses are naturally high, likely due to the transfer price being too high. So that's what we can say. Other than that, another point that we could potentially make is design division designs turbines and supplies, right? They're just making designs, whereas Gearbox and Seco are manufacturing components. What do you think is a larger market? The market for gearboxes and for components of gearboxes, or just for the designs of those things? Generally speaking, it's the actual products which will have a larger market than the services. So that could be another reason why gearboxes sales are higher. Okay, so let's make our points. First, let's just repeat the point for Seco. So Seco has the lowest asset turnover. This again is likely due to the high capital they have because of their multinational operations. Okay, and what about for the difference between Gearbox and Design Co? So we'll say Gearbox has a higher has the highest asset turnover. Let's go by the extremes. Highest asset turnover. One reason for this could be that they manufacture gearboxes which would have a larger market than what the design division does, which is make designs. Hence, Gearbox Co has higher sales comparatively, and a higher asset turnover. Okay. Now, why didn't I make the point for the expenses? Because I want to leave that for the operating profit margin part, right? So that we can bring that in as well. Because when you bring in multiple different facets and link them together, those are basically where you get the brownie points from the marker. They really appreciate that, right? So we're gonna make that point in operating profit margin. Operating profit margin. So we're gonna say Gearbox has the lowest operating profit margin, even lower than that of Seco as well, right? This is likely due to the fact that it is purchasing okay, let's go to the next one. That it is purchasing components from Seco which are overpriced. Due to this, its operating profit goes down, decreasing its operating profit margin, right? Furthermore, now we can link it to the furthermore, this explains why Gearbox has a lower ROC than design, even though it has a higher asset turnover. It generates less profits per sale dollar than design does. Okay, so we're going very extensive. Technically, we've made more than enough points at this level that we will easily get a very good mark. Okay, but let's see if we can go further. What other things can we talk about? So here, another interesting thing that we can talk about is that CCO has a higher profit margin, higher even than Design Co. But isn't that strange? Gearbox has such a low profit margin, and CCO, despite its ROC and asset turnover being so low, their operating profit margin is really good. What could be a reason for that? Okay, I want you guys to think outside the box. Look at the features. CCO, unlike the other two, it's a manufacturer, so you could say, oh, manufacturers have higher profit margins than service companies, but that's not true, because Design Co has also a higher profit margin, and Gearbox was written off because they're buying components internally. One other reason could be that CCO, unlike the other two, sells its components globally. Why do people sell their components globally in the first place? Because there's higher profit margins there, right? So we can make that point, okay? So CCO has the highest operating profit margin. This is possibly due to the fact that they have operations globally where they can earn better profit margins. Okay, so we'll stop here since I don't want the video to go too long, but just to reiterate for you guys, whenever we did analysis, notice how we went about it. First, we looked at extremes, the highest and the lowest. Okay. Second, we isolated the differences between the various divisions. That CCO has international operations. That Design division has a different nature. It's a service company compared to the other two who are manufacturers, right? That Gearbox, unlike the other two, was buying components internally. And then we worded and made our analysis around those differentiating features based on the numbers involved, right? And if you can link them up like we did, that's just brownie points. You're not expected to always be able to do that, but if you can, there's nothing like that, right? That really sells your analysis home. Again, you didn't need to perform an analysis in this level of detail by any means, right? So for example, if you compare this to the marking scheme analysis, this is much more detailed. So don't worry too much about that. It's just for your practice so that you get a hang of how to perform analysis and become comfortable with it, right? Okay. So let's move on to part B. The video is getting pretty long, so I don't want to spend too much time. Part B is a transfer pricing question, okay, and it's very good from a conceptual point of view. We'll start with the requirement again. Advise using suitable calculations the total transfer price or prices at which the components should be supplied to the Gearbox division from CCO. Whenever they say advise the transfer price, right, whether they mention using suitable calculations or not, usually they do. But immediately think minimum transfer price, maximum transfer price. And you can give the advice at any price in between the minimum and maximum, both the companies will be happy with. Okay, so that's what we're going to do here. Calculate the minimum transfer price for CCO to be happy with, and the maximum transfer price for the buying division, Gearbox, to be happy with. So it says CCO is currently working at full capacity. Full capacity immediately meaning there's no spare capacity. And what does spare capacity have to do with? Well, it might have to do with the potential opportunity cost, right? So the Rotech group's policy is that group companies and divisions must always make internal sales before selling outside the group. So there could be some opportunity cost here. Similarly, purchases must be made from within the group where possible. However, the group's divisions and companies are allowed to negotiate their own transfer prices without interference from the head office. ACCA has always charged the same price to Gearbox as it does to external customers. However, after being offered a 5% lower price for similar components from an external supplier, the manager of Gearbox strongly believes that their transfer price is too high, okay, and should be reduced. ACCA currently satisfies 60% of the external demand for their components, and its variable costs represent 40% of revenue. So let's do the easier calculation first. The maximum transfer price formula was lower of external market price or divisional net revenue. Now, like I said, divisional net revenue is rarely tested in the exam. 95% of the time it's not tested. So for divisional net revenue, you always immediately need to see if they give any details for additional selling prices incurred by the buying division after buying the component from the selling division. And as we can see from the table here, there's no such information given. Okay, so that means maximum transfer price is simply the external market price. Now the external market price, they said Gearbox division is being charged at by ACCA. However, after being offered 5% lower similar components from an external supplier. So the external market price has become 5% lower than what they're buying for right now. And what are they buying for right now? So if we go to the table, Gearbox is buying, the cost of sales includes the cost components, but it's not just the cost component. But we have it here. ACCA external sales 8010 and sales to Gearbox division 7550. So here's the twist for this question. Usually transfer pricing questions are on a per unit basis, not this one. This is on a collective basis, okay? So we'll say maximum transfer price is the lower of divisional net revenue and external market price. Okay, let's just give a heading before that so that we have some presentation here, right? So we're talking about the buying division, Gearbox. So let's give that heading, Gearbox, the buying division, right? And we'll make a generic point which we always should in a transfer pricing question. The buying division is concerned about the maximum transfer price, okay? And that builds into, so maximum transfer price is the lower of divisional net revenue and external market price. Divisional net revenue cannot be calculated in this scenario. Therefore, the maximum transfer price is the external market price. This has been reduced by 5% from what it was. Hence, the maximum transfer price is, and now we can do the calculation over here, and let's just stretch this a bit so that we have the coordinate. Okay, so it was 7,550, but it's fallen down by 5%, right? So it's become effectively 1 minus 5%, right? So it's become 7,172.5. okay, so that's Gearbox. Now let's talk about it from the perspective of ACCA. So ACCA, which is the selling division, and they're obviously concerned with the minimum transfer price. The selling division is concerned about the minimum transfer price, right? Generic point, and then we give the formula. Minimum transfer price is equal to marginal cost plus the opportunity cost on lost external sales, right? And in this case, let's start with the marginal cost and then we'll talk about the opportunity cost. So it says CECO currently satisfies 60% of their external demand for components. That will have to do with the opportunity cost. Its variable cost represents 40% of revenue. Okay. So variable cost is the same as marginal cost in this case, and it's 40% of revenue. But now the question, which is why I like this question from a conceptual point of view, which revenue do we take 40% off? 8010, 7550, or 15560? Which one? So in this formula, if we break it down, remember our video, marginal cost is based on, just like any transfer price, internal sales. So we'll do it based on the revenue for just the internal sales. So it won't be the 8010, which is for external sales, and it won't be 15560, which includes external sales. It will be based on the 7550. Okay, so we'll write that down and do the calculation. Marginal cost is calculated based on the internal sales revenue, internal sales. So marginal cost is equal to, and we can do the calculation here, so 7550 into 40%, so we get 3020. Okay, after that we have the opportunity cost. Is there going to be an opportunity cost? Yes. Why? Because CECO is working at full capacity. They're forced to sell first to internal divisions before selling outside, and most importantly, they're only satisfying 60% of the external demand. So they're not satisfying 100%. They're giving up on some of the external demand, 40% to be specific. Now, for opportunity cost, it's based on always contribution lost. We need to find out how much contribution they're losing on for not being able to make all 100% sales of external demand. Okay, so currently they satisfy 60% of external demand, meaning this 8010 represents 60% of external demand. But opportunity cost is not based on what you're doing, it's based on what you're giving up, what you're sacrificing. So if they're fulfilling 60%, they're sacrificing the remaining 40%. So we need to find the remaining 40% of sales they're giving up for the opportunity cost, where 8010 is 60%. So let's mention that. Opportunity cost is based on contribution lost. And here I want to highlight something important. Marginal cost was based on the internal sales data. Opportunity cost is being based on what we give up from the external sales data, right? So marginal cost has to do with internal sales, opportunity cost has to do with external sales. So contribution lost on foregone external sales. Currently 60% of external demand is met, so 40% is foregone. Okay, so say external sales foregone or given up basically is equal to, so if 8010 is 60%, how much is 40%? We'll divide 8010 by 60% to get the dollar amount per percentage and then multiply that by 40%. Okay, so they give up sales of 5,340, but we're not done here. Remember, opportunity cost is not based on sales but rather on contribution loss. So we need to find the contribution here based on this revenue data. So how can we do that? Very simple. Contribution is variable cost less sales less variable costs, and they've given us that variable costs are 40% of revenue. If variable costs are 40% of revenue, then contribution is effectively 60%, right? So what we can do is, let's just do the full calculation. External sales variable cost would be equal to 40% of this, so is equal to this times minus 40%. So contribution lost on external sales foregone. We need to stretch the column a bit. Let's stretch this one a bit more. Okay, is equal to these two. Right, so 3,240. We'll make this bold and we'll make this bold as well. Let's just cut this and paste this here so it's next to the equal sign. Okay, So those are our two amounts. Or we could have just taken 60% of 5,340. It would have given 3,204 as well. Okay. Therefore, minimum transfer price is equal to the sum of the marginal cost 3,020 and the contribution lost from sales foregone 6,224. Okay. So we have our minimum and maximum transfer price as well. Okay. So we make our conclusion. Let's give a heading to it. Conclusion. Any transfer price between the minimum and maximum limits of minimum is 6,224 and 7,172.5 maximum of respectively will be satisfactory to both divisions. Okay, or satisfactory for both divisions, rather, for both divisions. Okay, so we give our conclusion, we've given our advice, hence the advice is to set the transfer price between those limits. Okay, we've given our advice, we've shown the calculations, and we're done with this question. Okay, so the timer is currently at around 38 minutes, but I talked a lot, so a lot of extra stuff. So from an exam point of view, we're good. So yeah, that's how we do this question, analysis, calculation, and everything. I think that it's very good from a practice standpoint, because conceptually, one, it highlights being able to do analysis for the three ratios, and two, it's a transfer price question with a twist that instead of on a per unit basis, it was on a collective basis. And finally, it highlights the important fact that we covered in our videos, that when calculating minimum transfer price, marginal cost is based on internal sales data and opportunity cost is based on external sales data. Okay, so I hope you guys benefited from this video, and I'll see you guys next time.